Hi there, and welcome to Listen to the Market for February 14. I want to thank you for the comments that you've started to make. I'd like to thank you for the compliments. I do appreciate them. But most importantly, I appreciate your questions. The more questions you have, the more I can give you back in return, and that way you and I can turn this around from being a one-way street into being a two-way boulevard. Tongue twister. The first question that I want to address is the easiest one. What about indicators? Well, the answer is what you see is what you get, is what I see, is what I use. No indicators, no trend lines, nada. The price action is the driver. The price action is the primary source of all information in relation to what the market wants to do, i.e. the message from the market. The reason I use candlestick charts is not because of the candlestick patterns, rather because candlesticks far more graphically illustrate the battle between the buyers and the sellers. The reason I use black and white candlesticks is because the L.I.V.E setups themselves are black and white. No subjectivity, no analysis, pure price recognition. Either the setup is there or the setup is not there. So thank you for that question. The next question had to do with the application of the top-down approach. And specifically that question was, what is a trader to do in the instance where, for example, on the 60-minute chart, the primary chart, you have a setup to sell, and you also have a selling setup on the 15-minute chart. The 15-minute chart being the action chart, entry-level ISL and campaign management, but there is no selling setup in confluence on the 30-minute. So what is a trader to do? Take the short campaign on the 15, believing it will be a 10-hour return? Well, the disciplined trader will go tick for a 60-minute chart, tick for a 15-minute chart, cross for a 30-minute chart. Close, but close only counts with hand grenades. A pragmatic trader will say, well, the 30 minutes giving me the direction, courtesy of a sell setup. The 15-minute one, yeah, that's giving me a sell as well. Let's take the campaign. The outcome doesn't matter because it's the outcome of one of the next 1,000 campaigns. By breaking the discipline and not waiting for the 30-minute selling setup in confluence can be rather dangerous. So the best answer is wait. If the rule says 3 pigeons need to line up, clay of course, then wait for the 3 pigeons to line up. Okie dokies, now let's go through Tuesday's price action to see what opportunities were there applying the L.I.V.E concepts. As part of the daily routine, the daily process, always mark the previous day's highs on your price chart as well as the previous day's lows, the daily highs and the daily lows. The market has this habit of respecting those. Second part of the process always is to examine the previous day's range, the previous day's bar, to see what the message is in relation to price activity for the following day. So with that in mind, Monday's message was twofold. One, expect the range to be larger on Tuesday than Monday, so a larger range on Tuesday than Monday. And number 2, expect Friday's lows to be broken. Hence I plotted Friday's lows on all 3 charts. Bear in mind, these are probability-based projections, and as the old Chinese saying goes, predicting is difficult because it's the future. Let's see what happened on Tuesday. First hour of trading, the market broke down below Monday's lows, and the second hour of trading saw the market break down below Friday's lows. So far, prediction number 1, or probability-based forecast number 1, spot on cue. We're in the AA buy zone, which means we're looking for buy setups, and 2 hours later, L.I.V. students will recognize an RTV buy. The RTV buy means that you're looking to buy at the high of the setup bar with your initial stop loss at the low of the setup bar. Entry is not achieved on the first hour or the following hour. Now, one thing to point out is that this is occurring outside the optimal time window for the L.I.V. setups, for the L.I.V. top-down approach. Translation, simply use the hourly chart for your setups, for your entry, for your ISL, and for your ongoing campaign management. This bar, the highlighted bar, is a continuation of the RTV buy, So the entry now is the high of this bar, and the low of this bar is the ISL. Again, no entry. The following bar doesn't break the previous spike low, which means the RTV buy is still a buying setup. We're still in the AA zone. Looking to buy at the high of the bar, ISL at the low of the bar. The following hour sees the market rally, break your entry point, not break your ISL level, so formally one should be long on the basis of the RTV buy. The bar of entry itself needs to be examined to see whether it's confirming the bullishness that was established or presented by the RTV buy. So the higher high and the higher low, they're both bullish. The close in the wrong half of the range is not bullish. The close being below the high of the setup bar is not bullish. So on balance, the bar of entry is saying it's not confirming the bullishness. Translation in terms of action, get out of market. Why buy, hold and hope? Listen to the market. It's saying to you, on probabilities, you're on the wrong side. So 2 hours later, had you not acted, you would have been stopped out for a trail or initial stop loss. So by aggressively applying the concept of listening to the market means that you had a smaller loss than required. Focusing on the last 60-minute bar on the screen, you can clearly see that that bar represents a fake out buy on the hourly chart, the directional chart. I'm going to share with you now a variation on the theme in terms of using the L.I.V.E setups and the top-down approach. The top-down approach, as you recall, 60-minute, 30-minute and 15-minute. I'm going to share with you a variation on that theme, which is the 60-minute and the 30-minute, when the 30-minute one gives you a better entry level, in this case a lower entry level, than the 60. Look to enter on the basis of the 30, but manage it back on the basis of the 60. So the 30-minute has a buy setup, being a fake out buy, followed by a first bar reversal, looking to buy at the high through there, ISL down through there, which corresponds to the hourly low. Next bar comes along, entry is not achieved. You need to examine this last bar to see whether it's a buy setup. Yes, it is. It's an RTV buy. Entry at the high, ISL still remains at the hourly low. On the next bar, your entry is achieved. Your ISL has not been threatened. Nothing to do. By now, 2 30-minute bars means that 1 hour bar is also complete. Bit of a conundrum now. You're long, but the 60-minute hasn't triggered its entry point. What you have going for you is the fact that the 60-minute bar now is a fake out inside period known as a fifth buy. So all is well, your stop now gets simply raised from the low of the 60-minute there to the low of the 60-minute there. Next 30-minute bar comes along, nothing to do, your initial stop loss still is at these lows in through there, basis of the 30-minute chart or the 60-minute chart through there. Next 15-minute bar comes along, moving in your direction. The hourly bar is complete, so you can clearly see that basis the hourly bar, entry level has been breached for the hourly setup. ISL has not been triggered. So you raise your stop from down here to the low of this current bar. Now again, it's time to examine this current bar in terms of whether it's confirming the long side being the operative side. Higher high is positive, higher low is positive. Closing above the high of the setup bar is positive. Closing in the top half of the range is positive. So there's no message, there's no reason to adjust your stop other than a simple trail. So now let's just trail it on the basis of the 60-minute bar. Next 60-minute bar comes along, higher low. By now you're better than break even, bearing in mind your entry level was through there basis the 30-minute chart. So now your trail is better than break even. Next hour comes along, higher low, higher high, raise your TSL from there to there, thereby locking in some profits. Next hour comes along and we have yet a higher low still. So again, raise your TSL from there to there. Very straightforward, very simple. What I've illustrated is using the top-down approach in a different fashion, whereby the 60-minute gives you the direction, if and when, and only if and when, the 30-minute gives you a setup in the same direction as the 60, so it's the top-down, and the entry level is better than the entry level for the 60-minute, take the 30-minute. Less pips at risk means you can increase your bet size without increasing your dollar risk, which means you can increase your R return nicely. Once entry has been achieved, manage it purely on the basis of a 60-minute campaign. And as you can see, the stop has been raised to the lows through there. Next hour comes along, and lo and behold, you've been stopped out. Now your return in terms of buying at the highs through there, getting stopped out through there, you're looking at about a 2R return. Not too shabby. That's it for this time round. What I'm doing is gradually expanding your repertoire in terms of the L.I.V.E setups and the campaign managements. And I do encourage more comments, more questions, so I can give you back more in return. Over and out, and enjoy the journey. Bye for now.